Hello, everyone. Welcome to VC101 by MENAbytes and Modus Capital. We're just waiting for everyone to join in. First of all, thank you for applying for the program, the online bootcamp, and joining the first session today. We're just waiting for everyone to join in. Once all the members who have been selected join, we'll start streaming it live on Facebook and formally start the session. I have with me Kareem Elsirafy. He's the managing partner at Modus Capital. Thank you so much, Kareem, for first of all agreeing to do this together, and secondly making the time for this. Thank you.
Yeah, absolutely. Thanks, Zubair, for having me. Pleasure, and more than happy to share a little bit of knowledge today.
Yeah, looking forward to. I think I also want to learn a lot more than what I already know, and looking forward to asking some questions that I've always had about venture capital.
Awesome.
So we're still waiting for some of you to join in. We have some members who haven't joined yet. We'll give it another 2 minutes, and then we'll go live on Facebook. And those who haven't joined by then can perhaps join in later. So for those of you who are here to explain how this is going to work, Kareem has some slides, but we want to make it as interactive as possible. Even though there is going to be a dedicated 30-minute Q&A part for you guys who are joining us on Zoom towards the end. When you will have the chance to ask questions, you will be given access to microphone, access to speak. So you will be able to ask those questions. But if you have any questions, even while Kareem is talking about venture capital, or he's sharing the slides, and he's discussing different terms and concepts, please feel free to use the Q&A tab and share those questions over there, and he will try to answer them while he's still speaking about a particular concept. But if there's anything that you would like to get more details on, you're going to have those 30 minutes towards the end. I think we're going to hit live. We're going to start broadcasting this to Facebook, and then we'll formally start the session. Those who haven't joined until now can perhaps join in later. So we're live on Facebook. Thank you so much. Some of you have just joined. Thank you once again for joining in. First of all, for applying for the online bootcamp and then joining in. As I was explaining earlier, Kareem is going to run through some slides that he has prepared for this. For those of you who've just joined in, Kareem is a managing partner at Modus Capital. Modus is a venture capital firm based in New York with offices in Dubai and Cairo. They've been investing actively in the region for the last few years at least, have become more active lately. And Kareem will obviously talk about himself. We'll let you guys know more about himself and Modus. And then we'll quickly start the session formally with Kareem talking about venture capital. As I explained earlier, for those who are joining on Zoom, they will have the last 30 minutes of the session for themselves to ask any questions that they may have around venture capital. They can, if there is something particular to their startup, they can ask around that as well. And for those who are joining on Zoom, if there's anything that they want to ask during the session, even while Kareem is speaking, they can use the Q&A tab here and share their questions. Thank you once again, Kareem. If you can tell everyone a little bit. Can you hear me now?
Yeah, I'm good.
Okay. So if you can tell everyone who's joined in a little bit more about yourself and what Modus does.
Sure. Thanks, Zubair. Thanks again for having me. Pleasure to be here and hopefully share some valuable information with the attendees and the Facebook audience. So myself, I'm Egyptian American. Grew up in New York most of my life. Got into the space as an entrepreneur. Founded a marketing company and then a SaaS company, both in New York City. Was very successful, and when exiting out of those two companies, just began doing more consulting for early to mid stage companies in New York. Mobilized a team around us as kind of like a crew of operational experts, and kind of built this reputation as a high value, high growth creation team. And then from there, we had some interest from investors, who wanted to take advantage of the companies that we were taking from lower valuations to higher valuations and helping increase the value of these companies. Really wanted to participate in that upside. So that's when we really began putting together Modus and formulating it. And the Modus model really follows that experience. We have a team of operators that supports the portfolio companies in what it is that they need, not just deploying capital directly as an investor, which is pretty traditional in VC, but being able to provide a level of a deeper operational support.
Right. Thank you. Thank you so much, Kareem. Let's start talking about what we're here for today, venture capital. If we can start with those slides, and I'll interrupt you probably whenever I have any question around those things, and obviously we'll have questions towards the end from those who are joining us on Zoom.
Yeah, absolutely. Please feel free to interrupt me as often as you'd like. So give me a second here. Let me just going to share this here. All right. So just adjust the screen size here. You guys see the whole screen now?
Yes, I think it's perfect.
All right. So what is venture capital? Let's first start with the textbook definition, right? So it's a form of private equity. Private equity means ownership in companies that is held privately, not publicly traded on a stock exchange. And an investment vehicle, financing vehicle that investors use to provide startups and small businesses with money to help them grow, right? And the idea here is that if an investor invests capital at an early stage of the company continues to grow, generates additional users, revenue, and profits, and then from there ends up giving back the investor a multiple on the money that they originally invested. So the whole concept is $1 comes in and more than $1 should come out. That's the hope. Doesn't happen all the time. It's one of the highest risks of investments, highest risk category of investments, because investors are investing in such an early stage. Venture capital is the earliest institutional investor in the private equity landscape. There are other different types of investors, more like PE firms that invest in businesses that are already profitable, already stable, and help them grow by accessing additional markets, by optimizing their internal operations to increase profits, et cetera. And those are very, very low risk, right? But venture capital, again, has the highest risk profile because the money's coming in very, very early. What are some of the other things that to kind of consider in venture capital? So venture capital is usually managed by a fund manager. These fund managers usually have a track record as entrepreneurs or have an investment background in combination with a specific market expertise, right? So for example, if I come from a software background, I could set up a venture capital firm because I understand the software very, very well, where I invest only in software, right? If I'm a doctor and I understand technology very well, I may be set up a venture capital firm that invests into medical technology. Also doesn't have to be technology based. It could be, brick and mortar type businesses as well. So using that same example, I could be a doctor who invests in franchises of clinics, for example. Venture capital also goes into tangible type of investments as well, not just technology investments.
But it is mostly focused on technology investment. It's very rare that we hear VCs investing in other types of businesses, correct?
Correct. I mean, it depends on the market, right? Like, I think that predominantly venture capital is associated with technology, right? I would say predominantly technology. You can also find a lot of hybrids, right? Where they'll invest into companies that have technology as a foundational element that's helping it kind of like grow, that's accelerating the growth of the business. So it's providing a high level of value added. So you see a lot of that too.
Right.
All right, so moving along, how does the venture capital industry work in general, right? So what you have is you have entrepreneurs, right? If you look in the early days, it was primarily corporations, governments, and educational institutions that really would do a lot of the innovating. Right now, what you see is there's a big push on corporate venture, right? And this is corporations really pushing the envelope on innovation and essentially creating in-house incubators or idea labs for them to be able to create early stage companies that are supporting their strategic objectives. And what you see now is more of a role of these corporations and also governments in trying to develop, for example, specifically in the MENA region, these governments are trying to kind of like seed this innovation. And they do this by setting up accelerator programs, by having deploying some capital as into fund managers as a fund of funds, which we'll get to a little bit later. This money essentially goes to the entrepreneur, right? The entrepreneur also collects money from or can raise money from individuals, angel investors, high net worth individuals, et cetera, or friends and family, right? There's a saying, there's the 3 F's that you originally raised from in the very, very early stage, right? Friends, family, and fools, right? It's the people who really just kind of believe in you and believe in the concept that you have. It's just kind of like a running joke. So what you have is the entrepreneur. The entrepreneur has an idea. They're a subject matter expert in something. They understand a problem very well, or they see an opportunity based on their experience. Or maybe they're a technologist, a programmer who was just tinkering and created a product and it's just getting some traction. So this is essentially the idea, the very, very early stage. And then what happens is the entrepreneurs need to continue building this, right? In order to continue building or validating an idea, what they do is they need to be able to raise some capital. That might be to cover their salaries, it might be to hire some people, or in the very early stages, it might just be to spend money on advertising to validate the hypothesis that they have for their product. So what they do is they, again, collect capital or raise capital from some early investors. Those can be, again, Angel investors are also venture capitalists, but they're not institutional, right? They're just individual venture capitalists. And what they do is they get this money again from these investors with the notion that we're going to increase the value creation in what it is that we're doing and be able to give you back a return, right? So venture capitalists sit in the middle between entrepreneurs and private investors, right? Private investors are called LPs. Just to clarify, venture capitalists, if they're institutional, it's not somebody with their own bag of money, right? They actually have to go out and fundraise, and they have their own investors. So they're almost entrepreneur-esque in a sense as well, right? They have to do fundraising the same way entrepreneurs have to do fundraising. But what they're fundraising for is something different. It's an investment product, right? And that's a fund. So what they do is they go to investors, private or institutional investors, and they say, hey, I'd like to raise a pool of money, $10 million. I'm going to take that $10 million. I'm going to invest it in a bunch of really good ideas. Again, I understand a market very well, or I understand a specific industry very well. And I'm going to use that knowledge to invest and take the $10 million that you gave me and invest into companies that will give me a higher level of return. So they have a fiduciary duty, right, to their investors, because essentially what they're selling to their investors, or their LPs, we'll call them from now on, is investment service, right? It's an investment vehicle, it's an investment product. The same way that you have a stockbroker or a financial manager who takes your money and invests it in stocks, right, on the stock exchange, buying low, selling high, or shorting, or whatever the case may be, to essentially take your money and try to get you a return on it.
And what a lot of founders, especially in the region, don't know, that fundraising for a fund is way more difficult than fundraising for a startup. And you're actually in the middle of that. So maybe, you can talk a little bit about that as well.
Yeah, it's significantly harder. Let me give you an example. I would like to sell you these AirPods, right? Here, this is something you can see, something you can touch, it's tangible, right? It's one thing, right? But selling a pool of money, or selling an investment product that you're going to say, I'm going to invest this in lots of things and I don't know what they are yet, but I have a thesis, right, is significantly harder. It's called blind pool money, right? Because what's happening is you give the LPs an idea, right, of the types of companies you will invest in. You build a pipeline of potential investments that you would make in the beginning after you get your first batch of funding, to give them kind of a flavor of how and what type of companies they're going to invest in. And that also lets them know like how you think, what your approach is, and the types of companies you're identifying, and how you see value creation, right? But it's significantly harder than fundraising for one thing, right? One thing, they all have financial models, right? They all have growth projections, but it's, again, to mobilize a large pool of money to invest, based off of your market and your insight, and to be a value creator for it is significantly harder than raising for one specific product or service.
Right. And why do LPs decide to invest their money in a particular VC fund, in a particular manager? What is it that they normally look for? I know this is slightly off topic, but to give the audience some more background on this.
So it's a really great question. First and foremost, it could be track record. So you as a fund manager who have raised before and you've taken investor money and given them back a very solid return, like a 2, 3, 10x multiple on their money. So you have that type of track record. For me, for example, right now, I'm a first-time fund manager. I haven't managed funds before, but I have a track record as an entrepreneur, right? I understand what it takes to be able to build companies and to be able to exit them, having done it for myself and also as a service for other startups in the US. So that's my value added, right? And that's what gives them a level of comfort. But again, it could be on specific industries, right? It could be that, I don't have a track record as an investor. I personally have a track record as an operator, but maybe somebody has a track record of understanding an industry very, very well, right? And what they do is they say, I can identify opportunities, right? And my assessment is very credible in being able to identify those opportunities. So that's why an LP would invest with an individual, but you have to also understand that it depends on the asset class, right? Again, this is very, very high risk. So if you're an investor and you want to diversify, you're going to put some things in very, very low risk, right? Like let's say bonds, for government bonds, for example. But the yield is very small on those. You're talking about like very low single-digit percentages, right? You're not going to make $100 million on government bonds, right? Not in the short term, at least, right? But the riskier the profile of the investment, the higher reward opportunity it is. And venture capital is the highest risk, and as a consequence, it's also the highest reward, right? So you can invest money into 8 companies out of 10, and 8 companies will fail, but 2 will be rock stars, superstar unicorns, and they make all the money back. So it's also about the investor and what their risk profile is and how they're trying to diversify their assets.
Right, right.
Great. So there's another side of this as well, right? So the VCs ultimately, So the VCs, now the entrepreneur comes, the VCs invest into the entrepreneurs, into the companies, they get a stake in it, right? And this is again, LP money. And how do they actually make money, right? And we'll get to this in more detail a little bit later. But essentially what happens is these companies grow and the entrepreneurs need to have an exit and the VCs need to have some sort of liquidity event, right, of the companies in their portfolio to be able to actualize a return. So that comes in usually 2 ways. One is like an acquisition. You have a company, it grows, it gets market share, or it has a very high value proposition that's attractive for another company, and another company may buy it again to get access to its user base, to expand on its product or service offering, whatever the case may be, right? And what will happen is this company will buy it at a much higher valuation than when the VC firm actually bought into it. Again, giving the delta being a return that's going to the VC, right? And then another is an actual IPO, right? IPO stands for initial public offering. And this is when you actually take the company and take its shares and list it onto a public market, right? Like a stock exchange, et cetera. And what this does is you actually go from taking the liquidity event from a private institution or individuals actually to the public, and you sell single shares on the stock market that anybody can essentially buy and trade. And then this also brings back a return, because what happens is when you IPO, the price per share of the company actually gets validated in the market, and the performance of the company directly correlates with the value of the stock. So if a company is publicly traded and it has a really good quarter and it's showing really strong earnings, then usually the value of that stock will go up, right? And then people trade them, buy and sell them on a daily, weekly, monthly, yearly, or long-term basis. All right. So what's a VC's place in the ecosystem, right? There's quite a bit of other players. So what do you have? You have early stage, super early stage companies, and there's ways that they can get cash, right? There's competitions that is essentially grant money. I'm pretty sure we see that all over. MENA, reward-based crowdfunding, and then equity-based crowdfunding, right? So reward-based crowdfunding, for example, can be, we are going to set something up on Kickstarter where we have a concept for a product. We have a prototype of that product. We show you what this prototype is going to look like. And then somebody will actually prepay for that. You collect the money from a whole bunch of pre-orders and then actually produce it and then give the product to the individual when it actually goes to production, right? And then there's equity-based crowdfunding, which is essentially, again, small amounts from a large group of people to be able to collect enough capital to begin running, right? And then on the other side, you have incubators and accelerators. And what they do is they provide more like operational support, right? They're not really, you do see some of them that are a hybrid that provide operational support and some cash, but their primary function is to be able to help the entrepreneur and help the company get from 0 to 1, 1 to 2, and overcomes its early stage obstacles, and also teach the entrepreneur what it is that they're going to need as a skill set to be able to push and drive the company forward, right? So now, what do you need, right, as an individual? So you need cash, So you can go to angel investment. Again, that's the earlier stage, much smaller ticket sizes, or you need a lot of cash, and that's when institutional investors come in, right? And this is where essentially a VC's place comes in. There are VCs, again, that have their investment thesis around taking lots of smaller bets, like 500 startups, for example. They write ticket sizes that are of the same amount as angel investments to a degree, but they also obviously do follow-on funding with bigger checks as well as an institution. That's their strategy. I think it's a really great strategy. But again, VC funding is the first institutional money that you would likely be able to raise, or that you would be raising as an entrepreneur.
Right. And apart from getting this money from an investor who has a VC fund, what else do I get if I have a startup? In some cases, I understand maybe I take this as a validation that my startup was validated by an institutional investor. But apart from maybe validation and cash, what else do I get?
It's a really great question. So there's a couple of things. One is you get advisory from the VC's management team, right? That's something that they always give. If they're doing research or they're doing reports, they can give you data and analytics and insight. The other thing that they can do is mobilize more cash for you, right? VCs tend to collaborate very closely with one another. In some markets, it's very competitive in others, right? Where they say, hey, we think this is a really good opportunity. A company, for example, might need $5 million in funding for their A round, and the biggest check that I could write is $1 million, right? So I want to help them. I think it's a good opportunity. I want to help them get to that 5 million. So what I would do is I would go to other VCs in the network and be able to mobilize them. Other things that VCs can provide is specific subject matter expertise. Again, if I'm a VC that focuses on SaaS companies, and I understand SaaS very, very well, or I have people in my network that understand it very well, I may be able to facilitate some advisory or be able to provide some operational insight, some brain power, to the portfolio company.
Right.
Go ahead.
No, please carry on.
Other really big VCs that you see out west, some of them have really big HR departments, right? Because there's obviously a clear understanding that what makes a company, what makes it valuable, and a key pillar to its success is the team and the skills, right, that go into actually creating the value and pushing the company forward. So what they do, like Greylock, Sequoia, Andreessen, they have massive HR teams. And what they do is they put a whole bunch of money into a company and then unleash their HR team to go source some of the best talent, right? And bring that talent inside to the portfolio companies to give the portfolio companies the best opportunity for success.
Right. And if I'm an early stage startup and I have the option, let's say I have the choice to raise either from an angel or from a VC fund, what are some of the key areas that I should look at before, making this decision to understand which ones should I speak to? Who should I speak to, the angel investors or the VC funds?
Yeah, so you have to understand that the predominant job of a VC fund is to make money for their investors, right? So, it's not very short of an adversarial relationship to a certain degree, right? What they want is they want the best deal. So what does that mean? For every dollar that they put in, they want to get as much equity for that dollar as possible, because that equity that you buy for $1 today, you want to be able to sell for $10 down the road and be able to make $9 profit, right? So that's one thing to understand. My recommendation, I always say this to founders, is raise as little money as possible, as infrequent as necessary, right? Try not to really take money. In the beginning, angels are going to be easier. Why? Because they're not institutional. It's usually their own personal money. They're going to be way more lenient on terms. Some of them are financially driven, yes, but you'll find that they're more impact driven or see an opportunity or believe in an individual as well. Obviously, there's an economic element to it, of course. But angel investment is usually the easiest, right? But after a while, an angel investment, you also don't need to determine in the beginning a valuation for your company, right? What you can have is what's called a valuation cap. So it ensures that the investor will receive no less than a certain percentage of the company. But at the same time, it gives you the flexibility to be able to build the company and try to have as high of a valuation as possible. When you get to a VC, they're going to want to invest, and they're going to want to have a fixed price per share, right? And they call this like a
The
price
price
round.
round, right?
Exactly. Where you're actually solidifying. So you can have, let's say, 5 or 6 convertible notes from angel investors, right? And have raised $500,000, but now you're going to an A round. All of those convertible notes need to convert at a specific dollar value, which will actually get all of your angel investors a fixed number of shares, right? Of the company. So this pricing round involves a lot of things, right? You have to determine a valuation for the company. You have to substantiate that, right? Is it based off of revenue? Is it based off of users, projections, discounted cash flows? And there's multiple methodologies that they use, that you should use as an entrepreneur, and that a VC will use in their standard determination, right? Or their standard operating kind of protocol on how to value a company. So it's not an easy process, right? You're going to get scrutinized on the product. You're going to get scrutinized at a much deeper level than you will at an angel level. So it's a very rigorous process. So again, delaying that to the latest possible time helps you build as much value as possible before going to them. So you can essentially get the best deal. You want to have as much negotiating leverage as you can with a VC to say, no, I have this many users and the product is this developed, or I have this much revenue, right? To really substantiate a very strong valuation for you. So you give up a smaller percentage of the company for the money.
Right. Thank you.
Yeah, no problem. So how do venture funds actually work? So what you have is investors. We talked about that, right? They're LPs, and then you have the venture fund. So what you see here to the right, the 80%, 20% to GPs. So the managers of a fund are called general partners, right? Versus limited partners. They're the general partners that are essentially in the management company and make the investment decision and are responsible for creating value within the venture fund. And the way it works is that it's what's traditionally called a 2 and 20 structure. What happens is the investors get 80% of the total value of the fund when the fund matures, and the general partners get 20% of that, right, for their sweat and what they put in. At the same time, a venture fund has operational expenses, right? The general partners have to pay salaries, they have to have rent, they have to get some analysts, they have to do due diligence, etc. So this is where the management fee comes in. Management fees somewhere between 1.5% to 2.5%. 2% is usually the industry standard, and that's what they charge per year on the amount of capital in the venture fund. So if you have $100 million venture $1 million budget every year, that goes to management costs. So what happens is now you have the LP money pooled into a fund, and then it goes into portfolio companies, right? It goes into portfolio company A, B, and C. And the money that goes in needs to come out at a multiple, right? Not all of them do that. Again, inherent in venture, in early stage venture investing is a lot of failures, right? There's a very, very high risk. So some of these companies will fail, but ultimately what you need is the aggregate of the money that you invest out into these companies. You need the aggregate return to be higher than what the dollar amount of the fund is to actually be able to turn a profit, right? And that's essentially the goal of a venture fund.
Right. And I think the question that I have will probably be covered by the next slide or the one after that. So I'll keep it to myself. Yeah, I think.
Sure. So this is, again, kind of reiterating the previous slide, but we're adding another layer of deeper information, right? So the management company, again, is what gets the management fee. You have the carried interest, which is the 20% that goes to the fund managers or the general partners, right? And then you have the limited partner entity, right? So one thing about the limited partner entity is the fund has to have a maturity date, right? So usually 10 years is usually the average, and it's usually done maybe in 8-year with 2 1-year renewables, or 7 years with 3 1-year renewables, et cetera. And the idea here is that when you invest in a company, the life cycle for a company to go from early stage to an actual liquidity event, be it acquisition or IPO, is somewhere between 7 to 10 years, right? So what you want to be able to do is close that fund and then be able to distribute all of the returns to all of the investors. So its fund has a life cycle, right? And that varies. Commitments, they don't just come from LPs, but the general partners, as the managers, need to put skin in the game too. This is usually a big requirement from the LPs. Okay, you're going to manage this fund. We want to know how serious you are. We want to be able to share the risk. So you have to put in $250,000, $500,000, or a specific percent of what the fund is. So they really want you to have skin in the game. And then the other thing is like hurdle rates. So the 20% that goes to the general partners who are managing the fund, they only begin seeing that after they've returned a specific percentage of the principal capital that the investors put in, right? So if they raised $100 million fund, right, and they have to, and the hurdle rate is 80, right? What they have to do is they have to actually materialize $80 million first before they begin getting their 20%, right, and actually begin actualizing returns. The management company, and after a venture fund is set up, the deployment period, which is the amount of time that it takes for a venture fund to actually invest its money, is usually somewhere between 3 to 5 years, right? So even though the fund is 10 years, what you do is you deploy the money from anywhere from 3 to 5 years, and then the fund actually has to mature. The companies have to be given an opportunity to continue growing, and then having a liquidity event, hopefully before the 10-year period, where the returns actually come back. So after the first deployment period, the management company and the general partners are probably going to want to raise a second fund because there's more opportunities, right? And now they have a track record, right? So if they raised 100 million their first fund, they can probably raise 200, 250, 500 million. And what does that track record depend on? It depends on the asset value of their first fund, right? So if I had $100 million fund, and that fund now, because it's 5 years in and we've had some really strong exits, and that fund is now not worth 100 million, but worth 300 million, that's a very good indicator. And they can go and they'll raise additional capital, a second fund based off of that, and raise more money, right? But the management company stays consistent, right? The management company usually manages multiple funds, second, third fund, et cetera. And the LPs can be the same LPs. Most of the time it's a mix between the same and obviously new LPs that come in, especially because the pie gets bigger and the fund gets bigger.
Right. And what happens in case of an exit? So for example, if I'm a fund manager, if I've set up a VC fund and it's a $50 million VC fund, let's say in UAE, and I've deployed 40 million out of it, and it's my third year into it, and I'm super lucky, and one of my companies it exits at a very high valuation. What happens in this case? Does the money come back immediately and it goes to those investors who have invested in my fund, or what happens?
Yeah, so it's a really good question. There's different structures, but traditionally what happens is the money comes back and gets distributed pro rata to the investors, right? So until they make their money back again, or hit that hurdle rate, and then the profits then above that, now everybody. So if I owned 10% of the fund, I would get again, from $100 million fund, I would get my, $10 million back, and then additional profits, right? And I would get 10% of all the profits thereafter. So it usually does get distributed that way.
Right. So until the hurdle rates have been hit, the GPs, the general partners, the fund managers don't make any money.
No, because, investors want to secure their initial investment, right? Some of them require 100%. They say, we have to get all of our money back. It's a point of negotiation. We have to get all our money back before you see any profits, right? So you're literally just living off of the management fee, and it's a very long-term play for you. So you might not materialize until, let's say you have very late exits, you might not see a profit until year 7 as a GP. So again, it's hard for fund managers. It's not easy, right? It's really not easy.
Right. And generally speaking, I know there's no rule here, but generally speaking, on average, if you have an idea, because you've been doing this yourself as well, if let's say I'm doing a $50 million fund in the region in the Middle East, how many LPs would I have who would have invested in this fund, and what would they look like? You have some examples here, so maybe you can talk a little bit about uh, that.
Yeah. So how many? It's really tough. It depends on the size of the fund. Usually, a fund will have an anchor investor. That's somebody who kind of anchors it, puts a really, really big check in, and then that gives confidence and validation to the fund, and other investors will come in after that. But like a company, the more investors you have, the more people you have to manage, right? So trying to have as few investors as possible is usually good, unless again you're trying to diversify the investment pool. You also don't want to have one investor have too much influence or control, right? Although they traditionally don't have control, but they could be on the investment committee and help, need to approve certain things, for example. Some of the type of investors, professional institutional investors, educational endowments, right? So like endowments from colleges, ultra high net worth individuals, fund of funds. This is a lot of the time you see, again, in the earlier slides, we saw the government, right? There's a lot of government fund of funds that are essentially set up to invest into VCs. They don't have the acumen or the personnel or maybe the insight or staff even to be able to make direct investments. So what they do is they find good fund managers and then they give them capital to actually deploy. But then it may come with a mandate, right? So if I'm getting money from a fund of funds from Bahrain, they may require that a percentage of that money gets invested in Bahraini companies, because again, if they're state-backed fund of funds, they're probably trying to develop the local ecosystem, right? And so that's a strategic objective for them. Pension and insurance funds, these are all, again, they all have buckets of cash that they need to be able to materialize a return. They invest in multiple things, and venture can definitely be one of them. Corporations as well. We talked about that. You can have a VC, for example, that's just focused on fintech. And what you find is most of their investors are banks. Banks have, they set up a small fund of funds or invest directly. And then DFIs, which stand for developmental finance institutions. And these you find more in, they only really operate in like developing countries like Egypt, Jordan, the Levant, et cetera. They're mandated, they're primarily government-backed money from, the US, Europe, countries there, or China. And what they do, their goal is to try to help develop the local ecosystems, right? And so what they do is they, again, invest into funds as acting as a fund of funds.
Right. And when a fund manager, when a VC fund is raising money from LPs, do they look for anything apart from money? So when startups are raising money, like you explained earlier, they perhaps have to look at the value add side as well of VCs. Is it similar for VCs, or they're only looking for money and that's it?
No, 100%. Every investor has their own profile, right? The same way that you have a profile for an investor to invest in a startup company, right? Every institutional investor or an investor for a fund also has a profile. Some of them may be, so for example, here, educational endowments may want you to invest, or may have a mandate that there's going to be some sort of social knowledge, educational value added, right? So they may want you to invest in companies like e-learning platforms or something, right? Pensions and insurance funds usually like a de-risked method, right? They don't like to really do like high risk unless it's a small ticket. Again, corporations, if it's a bank, right? If it's an automotive group, right? They also have like a specific flavor. So every investor has their own flavor. And what you need to do is you need to be able to identify, okay, these are my target LPs. what is it that motivates them? Okay, this one is good for me because it matches my investment thesis and my investment strategy. This one doesn't. So be smart, right? You don't want to waste their time, your time, and engaging with somebody. You know, if you're going to be investing in eggs and, you know, somebody is an automotive guy, you know, it's just not, it's not the right fit.
Right. And what we see in the Silicon Valley, at least, and I think we'll start seeing it in the region as well, perhaps within the next few years, is that a lot of founders also become LPs when they get an exit.
Mm. Yeah, absolutely. I mean, it's a really good point. You know, they're paying it forward. You know, founders understand. You know, they have a big exit. For them, it might be because they want to invest, right? They want to put their money to work and they want to get a return, right? It may be because when they were founders, a VC firm invested in them and they got to know them very well. They got to understand their investment strategy. They obviously made good choices because they bet on them and they had a successful exit, right? So maybe they want to invest and support them in a future fund. So yeah, you do see a lot of that, and it's starting to happen now. It's fairly early, but what you really see right now is these people who have had good exits actually investing directly in the startups as angel investors versus into the funds.
Exactly. Yeah. Yeah.
Great. So how do VCs make money? So we kind of touched upon this, right? Short-term management fees. What do? Covers the expenses to live for the GPs. Travel and source deals to conduct due diligence, rent for an office. There's a lot of legal, right? Think about all of the legal contracts that you have to do to invest in a company. A lot of it is standardized, but, you know, going back and forth and conducting legal due diligence, you know, costs money. Fund management and reporting, right? As an investment product, you have to send regular reports and get audited on a regular basis and be able to provide that to your investors. But ultimately, what do management fees pay for? They pay for the fund managers to be value creators. They're supposed to create value in the fund. Again, and if you look at on the right side, what you see here is the long term is to take this fund, to put $1 in to a portfolio company or into a group of portfolio companies and have multiple dollars comes out. And this is essentially value creation. They want to increase the asset value of this fund, turn $100 million into $300, $500, $700 million, right?
Right. I think we can take a question from the audience. We've had this question, perhaps a little off topic right now, considering the slide you're on, but if you can answer, do successful companies ever buy back equity from their early stage investors?
Yes. So companies usually, there's lots of different transactions can happen. So companies may request a buyback, right? A first right of refusal to buy back equity that goes out. That's something that happens. They may want to do that because they want to bring capital in-house, and they also may do it because they want to be able to create room on the cap table for a bigger, more strategic investor down the line. They may want it because they want to have more options for founders or for staff, right? But one of the other things is that the investor has to be willing to sell, right? And the investor can sell. If you buy stocks, you don't necessarily, or if you buy shares of a company, you don't necessarily have to wait until exit. So I can be a VC. I can buy a stock in MENAbytes at the value of $10 a share, right? In an A round. When they're raising for their C round and the company valuation has it at $30 a share, right? I can sell to an outside investor that's coming in who wants to buy my shares and actually exit, right? Without a major liquidity event, right? Without it IPOing or without it getting acquired. So yeah.
These are called secondaries.
Secondary markets, exactly.
Right.
Yeah.
And we're starting to see them in the region as well. We're seeing a lot of early stage investors who had invested in companies are exiting, selling to the new investors in subsequent rounds. We've seen that happen with a few companies here in the region. So it happens, but it does not happen it is something that still happens very rarely, as far as I know.
Yeah, and there's also a secondary market and more mature markets like the US is founder stock, right, or employees. Most of them have restrictions on them, so they can't sell until after IPO or after a certain point, or the company again has the first right of refusal to buy back, not just from investors but also from employees if they want to sell. But there some do have the ability to be able to sell in a secondary market, employee shares.
Right. Now here, you've explained how do VCs make money, and I think it's very clear. Now there are different partners at a firm, and the carried interest for the firm is 20%. How does that get distributed among partners, and who else at the firm at the VC fund gets that money?
It's a really great question. So the 20%, think of it as 100% shares, right, of the 20%. So that can get distributed in whatever way the management wants. So if it's two partners, they can come in and they can say 50-50, which means each one of them gets 10% of the carried interest, right? Like any company, you probably want to have essentially an option pool, which essentially to incentivize staff that you're going to need. So as a fund manager, I'm probably going to need like a senior analyst, a principal. I may have somebody who's like an operator on staff. Like again, if I'm a SaaS company, I may have like a in-resident CTO or something like that. And you want to incentivize them, right, on the upside and on the long term. So you can split it up essentially any way, the same way you would split up shares of a company.
Right. And what I've seen happen in the West is, for example, if an analyst or if somebody junior at the firm sources the deal, eventually there is a specific partner that would make the investment, and he will be the one who will have the future relationship with the company, not the entire fund. Obviously, everyone at the fund would know the founders, but there is this one specific partner that would have a continuous relationship with the founders. What happens in the Middle East? Is it the same, or do funds do things differently over here?
Yeah, no, it's pretty similar. There's usually one point of contact, the person who's looking at the deal, who's spending the time with the founder and the founding team, getting to know them on a personal level, in addition to getting feedback from their analysts and principals, et cetera, on the due diligence and kind of like the nitty-gritty stuff. But it's usually traditionally like one point of contact. But you still get exposure to the other partners, right? So if there's a firm that has two managing partners, you may have a strong relationship or a lead with one who essentially led the deal, for you. But I'm sure it's a very small community, so I'm sure you're going to get exposure to some of the other partners as well.
Right. And this particular partner who has partnered with a company to invest in them, does he get usually a bigger share from the carried interest of this particular exit, or carried interest is actually aggregate of the entire pool of the exits that a fund gets?
Traditionally, the carried interest is an aggregate of the entire fund, right? There are specific structures. So one of the things that VCs do to be able to source deals and find good deals is they have what's called a venture partner, right? And this venture partner can have a responsibility to identify good investment opportunities, right? As a VC, and especially in a competitive market, what you want to do is you want to have like as many tentacles out there as possible to identify good opportunities. And what may happen there is a VC, for example, may have a structure with a venture partner where they don't give them part of the carried interest, but what they give them is a percentage of what they invested in. So if they invested $100,000 and got 10% of a company for that $100,000, they may, of that 10%, give 0.5% or 1% to the venture partner who found the company, for example, right? So it could be set up like that. But traditionally, between the LPs or the GPs within a fund, it's usually on a whole in the carried interest.
Right. Thank you.
Yeah. All right. So this is just an idea about value creation. How do VCs, this is essentially what we do at Modus, how do VCs look at actually creating value, right? For us, we like to focus on a utility, what a very functional value added And then that has its own, this is for a SaaS product, but it has its own, multiplier, valuation multiplier, right? And then as you kind of build, if there's an opportunity to get network effects, right, and you start building a community, right, within the product, right, and that could be just the amount of users, for example, that are on the product, or it can be, if it's a social type of product, it's a community in a different way, not just like SaaS users, right? But it could be individual users. And then what you have is you can have transactions. After that is transactions economy of scale, where you can essentially create like a larger marketplace, right? And this, again, you can see the value increasing as a company goes through these different phases. And here's one last example at how to actually, when you look at a company, how it actually goes through to how it increases in value throughout its growth phase, right? So month one, you have a friends and family round, you have a concept, a beta or a pilot, right? And then after that, and that's, let's say you do that in 1 month. Then after that, you have 3 months of creating this. And what you do is you raise $500,000 and you give up 10% equity. And what you get is a $3 to $5 million valuation, right? And then you continue building, you start getting users, right? You get organized, you have an MVP, you go out and you go out and you have an asset in either the product because you're building a strong engine or algorithm or whatever the IP of the company is. And then you go and you raise additional capital, right? You're going to now finance $2 to $3 million, again, for 10% equity, and you get a $15 to $20 million valuation. So you can essentially see like the life cycle of the progress of a company, and it can be, this one is more tailored towards the IP being in the technology versus it being like number of users or revenue, right? Which is something that is primarily more focused in the region. It's usually on number of users or primarily really revenue, because there's a different type of investor profile here.
Right. And these are obviously just examples. This is not what is happening in the region. I mean, in some cases, yes, it might be true. This is what happens in the region. But in some cases, the valuations are totally different than the valuations that we see in the region.
Absolutely. They're a little bit more slow growing because it takes a little bit more time, because there's a little bit less capital. The markets are, they have different attributes, consumers and businesses have different attributes, different financial systems, et cetera. This is an actual real live example from the US, from New York.
And also when we talk about the Middle East and North Africa, there are some countries where, you get a discount. For example, if you're investing in a startup in Egypt, you're going to get a much lower valuation, which is great for an investor than what you are going to get, for example, in a startup in UAE. This is also something that happens in the region.
Yeah, that's a really good point. It's really about like supply and demand, right? Like if there's more capital, for example, in the GCC region, they're obviously wealthier countries. There's more capital and there's more access to capital. So entrepreneurs are essentially going to get a better deal. Somewhere like Egypt, where there may be less capital and the cost of doing business also is like less, for them to be able to raise the same amount of money or half the money, they can maybe all other things equal, they raise the same amount of money and give up additional equity, right? And that usually comes in what you refer to in the form of a discount, right? 10, 15, 20% discount, which is essentially if I'm investing $100,000 in your company, it's as if I got a 20% discount, it's as if I invested $120,000.
Thank you, Kareem. Do you have any other slide that you would like to share, or? Okay, I
no,
think that
just, yeah, that's it.
I think.
Zubair, you're on mute.
Can you hear me now?
Yep.
Yeah. So another topic that we wanted to cover in this session was why venture capital is not for everyone, not for every startup. And so if I'm a startup, if I'm an early stage startup, how do you've already explained, some of the benefits of choosing an angel investor over a VC fund or vice versa. But how do I know if I actually need external investment, or should I just try to make money from the users that I'm trying to bring to my platform, whatever it may be?
Yeah, I think it's a combination. It could be a lot of different things. So if you need money to validate an idea and you don't have the capital, then you're going to need to bring in outside money. Some businesses grow organically, right? You can have a business model where you have good unit economics, right? And you bring in money, and with the money that you bring in or the profit margin that you bring in, you build the company organically, right? But let's say you're doing that, right? And there is the concept of time to market, right? Let's say you see a big opportunity, and you know that with your own internal funding, right, leveraging your profits, your revenues and your profits to grow, you can grow 3x in 10 months, right? But you know that based on your unit economics and your customer acquisition costs, et cetera, that if you had $500,000, instead of growing, 5 or 7x, you can grow 30x, right? So it may be worth it for you to take in outside money to get to the market fast, to capture a bigger market share, or to accelerate growth. You're on mute.
I keep forgetting that. But you also have to be careful with with the kind of investors that you bring in, because this is going to be a very long relationship, and you don't want to bring investors for the sake of money that you would regret probably a few months down the line, or maybe a year down the line.
100%. I tell entrepreneurs this all the time. So if your startup is a car, right? You are the driver and the money is the gas, right? Do you need gas to win the race? Yes, you need to put gas in the car for it to move, right? But you understand the value, right? Like, you as the driver, you're the one creating a lot of the value. What am I trying to get at? The same way an investor has the ability to scrutinize you and do due diligence and make sure it's a good fit for them, you also have that ability. Don't be blinded by the money or have a bias or think that, look, when you have money, people think that when you get money and you raise money, it's going to make things easier.
That doesn't happen.
It doesn't happen, right? It doesn't always happen. If you have a fire and that fire is controlled, right? And money is gas, and you pour gas on that fire, it's going to grow, and it's going to grow in a good controlled way. If that fire is a mess, right, and you pour gas on it, you're just making it worse, right? And I think a lot of people don't really understand that. They think that money will fix their problems. Look, money may make you sleep better at night in the beginning, but then you're going to have pressure to perform. So make sure that make sure your ducks are in a row. You're very organized. Make sure you need it. And then make sure that you are like-minded with the investors that you're getting money from, right? If you get the feeling that an investor is going to scrutinize you, or an investor wants to have very heavy operational involvement or control mechanisms on, decisions on your day-to-day operations, that may not be a good fit for you. But maybe it is, right? Maybe I'm building a company and my investor is a subject matter expert in the industry that I'm in, and I actually want him to get on a call with me once a week and help me make strategic decisions, right? So it's a give and take, right? It's like you said, it's a relationship, and you have to understand what is it that you want from a relationship, right? Do you want somebody that's going to provide X, Y, Z, or not?
Right. Extending this question a little bit, a lot of people I've seen on forums, I've received emails from a lot of people, and this was one of the motivation behind doing this too. That I receive a lot of emails from people in the ecosystem who have entrepreneurs in the ecosystem who have confusion around venture capital, around raising money and all. Now, if I'm an entrepreneur and I only have an idea, can I go and raise money?
You can, but
you should not.
It's going to be very, it's going to be very hard. It's going to be very hard here, right? What we've invested in somebody who came with an idea. But who was that person? This person was a super subject matter expert in something very specific, right? And we were like, okay, he has an idea. We obviously do due diligence and we test to validate that idea with him. We put in a little bit of effort to do it before we made the investment. But you will find that a lot more in developed markets, right? Because there's more access to capital. The entrepreneurs, respectfully to entrepreneurs in the region, usually have more experience, have done this before, more wins under their belts or failures, right? You get to also know what works and what doesn't work by failing as well. So yes, I think in this region, it's significant. It's very, very hard. But try to just think about how to be as lean as possible to validate a hypothesis, get some data, right? Like even if it's early data, be like, hey, you know what? I want to know if I want to build an app for barbers on demand, for example, okay? This is what you do, very, very simple. You don't need a lot of money. Set up a landing page, right? With an inquiry form or a phone number, buy a burner phone, right? And essentially spend $50, $100, $500 on social media or Google ads, and have a couple of barbers on standby that will go and do house calls, right? And just do the process manually, right? You may find out that you spend $500 and you get 500 requests, or you get 250 requests, right? Oh, there's some validation here. Then go and begin putting something together and presenting it.
Right. Absolutely. I completely agree with that. And I think that's the route a lot of startups have taken in the Middle East. Not everyone, tries to do this, but this is one of the best ways you could try to validate your idea by spending very little money, especially in the beginning. It doesn't have to be, you don't even have to write a line of code, and you could still validate. Obviously, it depends and varies, but there are different options available for different types of startups. The last topic that we have for this session is overview of venture capital in the Middle East and North Africa. In this particular, speaking about this, I'll be sharing a list of VCs that we have on MENAbytes, and I'll explain how you can use this list to source the investors that you should potentially approach for raising a round whenever you're raising money. We'll try to share some quick tips, but this is just to give you an idea. Obviously, those who are raising money are in a much better position to decide for themselves, but I'll be sharing a few quick tips. I'm going to share my screen. Okay, so this is a list that you can find on menabytes.com/VC list. It's a pretty simple Airtable, has the names of most of the investors active in the region, VC investors active in the region, accelerators too, and some angel groups as well. Now, you can filter them by their headquarter location. You can filter them by investment stage. You can filter them by their other offices. There are options for you to either filter them or sort by using these options at the top. Now, what you have to understand as a startup, and Kareem, please feel free to correct me wherever I'm wrong, because I don't know much about this. I'm just trying to share what I've learned from people like you. And so what you're going to do is you have to sort of understand what stage you are at, and then you go and try to understand which regions do these investors invest in. That is also available. If you scroll to the bottom, you will see that you can also scroll to the right of this table, where you can see the regions that these investors are active in. This data has been taken from their website. So obviously you'll have to do a little more research on your own as well. You'll have to go to their websites to perhaps learn more. And even though the websites of VC funds in the region do not offer a lot of information. They usually have all the necessary information available for you to be able to decide whether you should try to pitch to this particular investor or not. So for example, we have Beko Capital, MEVP, Modus as well here, Endure, and a few other investors. Now you have to look at investment geography and see which, if you want to, for example, if you're looking for investors who invest in the entire Middle East and North Africa, those who invest in MENA founders. So if you're a MENA founder but not based in MENA, based out of MENA, there are some investors in the region who invest in those founders too. You have to look at that. And then you obviously have to go through their websites. There are some details about their portfolio and their exits here as well. And there are some comments too. So this says generally invests in startups. And if I could expand this, I'm not sure why I'm not able to expand this, but if you're able to expand this, this says that they generally invest in early stage startups in the Middle East and North Africa. Now, if you go Beko's website and see the companies that they have invested in and the stages that they went in at, you will get an idea if they are right for you or not. If you look at MEVP, for example, you'll get an idea. MEVP currently, the only MEVP manages multiple funds, and the only fund that is active, the only MEVP fund that is active invests in Series A and beyond. And when you as a seed startup are trying to pitch to MEVP, for example, you're making a mistake. That's your first mistake. You don't have to pitch to MEVP when they are not even investing in the stage you're trying to raise money for. You also have to look at geography. See, sometimes the investors will make exceptions when they are, for example, getting, like Kareem said, they invested in somebody who just had an idea, but this was an exception. This is not something that is their part of their thesis, and this is not what they will continue doing with everybody who's coming in. So you have to differentiate between exceptions and thesis. Global Ventures, for example, invests in Series A, pre-Series A, Series A, and beyond. Now, if you as a seed startup go to them, you're probably not going to hear back from them. In some cases, yes, you might end up, getting an email back from them where they say that they would like to stay in touch and see your progress. It's always good to, get in touch with investors, but you have to decide which one you should focus on, because it is taking a lot of time from you as a founder. You are making a lot of efforts. So you have to, this is the first step that you should carefully consider and work on while you're trying to raise money. Obviously, there are a lot of other things that Kareem has talked about some of them, and he will be talking about a lot more in the next 3 sessions that we'll be having. But to give you an idea of how you should select, obviously, this is not all the data. There are other platforms too. There are other mediums too. There are websites of VC firms. There is LinkedIn, which is a great resource. But the idea is to do proper research before you go and knock on a VC's door with your pitch. If it is something that they're not interested in, don't consider pitching. So I'll share this one example. There is a particular, so let's just say that there is a particular VC in Egypt or UAE, and they say that they invest all around the region. But when you go and you look at their portfolio companies, you find companies only from one particular country. There are no other companies in their portfolio. Now, this could be because of 2 reasons. Either the VC invests in this particular market because of the mandate from their LPs. They are required to invest in this particular market. So for example, Algebra Ventures in Egypt, they would only invest in Egypt, majority of their fund, and only a small part can be invested in companies beyond Egypt. And you have to consider this. You have to, like I said, do your research. Try to go through the websites of these firms. Try to keep an eye on their announcements. You don't have to read the news all the time. I don't think it's a good idea to keep following just everything that pops up on MENAbytes or any other platform. If you're a founder, your focus should be obviously building your company, but keep an eye on, on the announcements of the firms that you're trying to target, and try to learn if the startup that you're trying to build is something that these particular firms would be interested in, and then go and pitch to them. And as angels are obviously great source, especially early on. You can raise, I think generally angels are obviously a lot quicker than VCs, because VCs make their decisions by speaking to their, obviously there are investment committees at VC funds that help them make their investment decisions. When you're speaking to an angel, you are I'm just trying to cancel the screen share. When you're speaking to angels, it's like Kareem said, it's their own money, so it's a lot easier for them to decide and invest. And yeah, that's about it. And now we're going to
just add it. Let me just add just a couple of things. You made some really good points, Zubair. Look, time is the most valuable commodity that you have. It's the only thing that you never get back, right? Like yesterday is yesterday. It's never going to come back, right? So make sure that you are valuing your time, and you're valuing also the time of investors. So yeah, definitely research the investors, research the region that they invest in, the industries that they invest in, and the stage, right? Ticket size, something critical for you to be able to assess, like you said, Zubair. A couple other things that you can do is look at their portfolio, right? Look, and you'll get an idea of the flavor of companies that they're in or that they would like to be in from their portfolio. So they may say that we're industry agnostic, or we do, like med tech, but you might find out that they do like SaaS med tech, and they don't do anything consumer facing med tech, for example, right? It might be very like intra-org operational type of products. The other thing about the portfolio is some of the best resources that you can have on whether or not you should pitch an investor, and somebody who may very well have a little bit more time and be willing to help out, is the founders of portfolio companies. Just give them a call, shoot them an email. Most of them will be happy to say, hey, like took a quick look at your deck, or hey, happy to have a 15-minute conversation. They'll tell you what the process was like, how the VC thinks, what are some of the requirements. Like they've already gone through the process, right? So that's something that could be very, very valuable. So you, again, you can understand who to present, and if they are somebody that is good for you to present, be prepared, right? For you to be able to be prepared. Another thing that you can do also is just research the partners, look at their background. That also may give you an idea of, what industry they came from, what experience they kind of have. So.
Right. Absolutely. That's perhaps the best way to go about it. Reaching out to founder of a portfolio company of a particular VC firm that you're trying to target, especially if you don't know anyone at this VC firm. Thank you so much, Kareem. We're going to stop the Facebook live stream. We'll be having a Q&A session with those who have joined us on Zoom. And thank you so much everyone who joined us on the Facebook. And we'll have 3 more sessions of this particular bootcamp next week, the week after, and one towards the end of this month. Okay, I think we've stopped streaming. So now the floor is open for questions for those who've joined us on Zoom. We already have a few questions. If anyone, so you have 2 options. You can either share your questions in Q&A tab, or you can raise your hand and you will be allowed to speak to ask your questions directly from